Hi, welcome to my channel. As a Canadian living in Canada earning Canadian dollars, and you have decided that you wanted to follow the investment advice from the greatest investor, Mr. Warren Buffett, which is to invest in the US index such as S&P 500. The first question that may come to mind is, can you invest directly with your Canadian dollar, or do you have to convert them to US dollar first? And the answer to this question is yes. You can invest in US index such as the S&P 500 or the Nasdaq 100 directly with your Canadian dollar. You don't need to open a US dollar account for this. That being said, I will do a separate video later on how you can cheaply convert your Canadian dollar into US dollar for people that want to have more exposure to investing in the US stocks. So make sure you subscribe if you don't want to miss out. When we look up the US index tracking ETFs that are offered in Canada, these are the ETFs that you will likely see. Here I've categorized them into the S&P 500 and the Nasdaq 100. But you will notice there are two types of them. One is Canadian dollar hedged and one isn't. So what is the difference and which one should you choose? And before we get into the details, I know some people will assume that the ETF that provides the hedging would have a higher management fee. However, I can tell you that is not the case. The ETFs provided by the same issuer generally have the same management fee, so we can ignore the fees for now. That being said, there is a catch, and I'll cover that later. Basically, hedging is a protection mechanism to protect you from the drop in the US dollar currency, so your investment doesn't lose value due to the weakness of US dollar, and tries to mirror the performance to just the index performance only. So which one to pick? It really depends on what your expectation of the Canadian currency in relationship to the US dollar going forward. If you expect US dollar to weaken against Canadian, then the Canadian hedge ETF will most likely perform better than its non-hedged counterpart. This is because the underlying asset in these ETFs are US dollar based. If the US dollar currency drops, then when these underlying asset values are converted from US dollar into Canadian, you will lose out a portion due to the US dollar depreciation. On the other hand, if US dollar strengthens against Canadian, meaning the Canadian dollar drops in value, then the non-hedged version would outperform the hedged ETF. Because the performance of the non-hedged ETF is equal to the performance of the underlying index, let's say S&P 500, plus the amount that the US dollar appreciates. To summarize this for you, if you expect US dollar to drop its value significantly against the Canadian dollar, then you might want to invest in the hedged ETF, as the hedging really means to protect you from currency fluctuation, and in this case specifically, to protect your investment value from a drop of the US dollar. So, during a period such as this, when the US dollar value has increased to the highest point in the past 10 years, especially when the increase was fairly rapid, then, based on historical data, it's highly likely that we can expect a drop in the US dollar, meaning the US dollar will weaken against Canadian. But if you expect Canadian dollar to weaken and that the US dollar will be stronger, then you probably want to invest in the non-hedged ETF. Again, hedging is a protection mechanism to protect you from the drop in the US dollar currency, so your investment doesn't lose value due to the weakening of the US dollar and tries to mirror the performance to just the index performance only. Then you might wonder, what if I simply have absolutely no clue about the currency trend, or I think that the US dollar and the Canadian currency exchange rate will remain mostly unchanged over the long run? In this case, I know some people might suggest you to invest in the currency hedged version so you can completely ignore the effect on the currency exchange rate. However, my thought is actually the opposite. Personally, I would favor the non-hedged ETF for two reasons. The first reason is because US dollar is the world's dominant currency, and US being the largest trading partner of Canada, it's probably a good idea for your finance portfolio to have some exposure to the US currency. This might sound a bit weird, but by not hedging on the ETF, you are actually making a hedge on your entire finance portfolio by holding onto pure US dollar asset. And let me explain. If your entire wealth is based on Canadian dollar, then when Canadian currency drops, your entire wealth suffers relatively to the world. By having a weak Canadian currency, we will likely see higher inflation inside Canada. And so your purchasing power decreases, whether you're purchasing domestically within Canada or abroad. Goods from other countries will become more expensive due to the weaker Canadian dollar currency. On the other hand, if you have exposure to US dollar asset, in this case, the non-hedged ETFs, if the Canadian currency drops against US dollar, while your wealth measured in Canadian, such as your salary and your savings account, will lose its purchasing power, because you have these ETFs based on US dollar, their performance will outpace the performance of the stock index, and therefore provide you with a much higher return to hopefully help offset some of the purchasing power that you are losing from your salary and savings account. Even though in a strong Canadian currency scenario, the performance of these non-hedged ETF would lag behind its underlying index, there's no impact to your overall purchasing power though, because the Canadian that you are earning from your salary has now a stronger purchasing power. Since that we import into Canada is cheaper, when you travel abroad, you will also find the cost in other countries to be cheaper. Man, I really miss that brief period when Canadian dollar was trading 1-to-1 to the US dollar. So let me recap. The first reason to invest in non-hedged ETF is by getting exposure to US dollar currency. You're actually doing a portion of hedging to your entire wealth portfolio. The second reason is that complexity comes with a cost, and this is an important concept to remember. Earlier in this video, I said, while the management fee for the hedged and non-hedged ETFs are typically the same, there is still a cost for doing the currency hedging on a daily basis. Nothing is free, and this cost will be reflected in the ETF's performance. While the value is insignificant in the short run, when we're talking about a multi-year investment horizon, it can certainly add up. Meaning if, hypothetically, the exchange rate between Canadian dollar and US dollar remains the same going forward, the non-hedged ETF will outperform the currency hedged ETF. Again, this is just my own opinion, and there's really no right or wrong with either choices, as no one can predict the future. Whether you hedge or not, the key is to stay invested. Okay, so that's it on the difference between the Canadian hedged ETF and non-hedged ETF in Canada, and how to choose between them. One thing I just wanted to say for those who are new to investing, you might wonder, what about US index mutual fund offered by major banks? Why I didn't talk about those and only focused on the ETFs? And the answer is simple. For investing in the identical asset, in this case the US index, the mutual fund's management fee is much higher than the ETFs. Why pay extra to these banks for investing in the same underlying asset? Now, in the older days, mutual fund might make sense for small investment because there's no transaction fees. But in the more recent years, with many new online brokerage that offers very low transaction fees, there's really no reason to choose mutual fund over ETFs, especially as your investment grows over time. That difference in the management fee will cost you a lot down the road. Thanks for watching. If you find the content helpful, please help me out by clicking the like button and the subscribe button. And if you have any questions, please leave them down in the comment section below. Alright, I'll see you next time.